The interest rate on your credit card is the most weaponized number in all of consumer finance, and the way it is presented to you is specifically designed to make it feel smaller and less dangerous than it actually is. When a bank tells you your card carries a 20% annual percentage rate, your brain processes that as a single yearly number, but that is not how credit card interest actually works against you in real life. Credit card interest is calculated daily, not monthly, and not yearly. That annual rate gets divided by 365, applied to your balance every single day, and then compounded on top of itself continuously. This means your debt does not grow in a straight line, it grows in a curve that accelerates over time, and the longer you carry even a small balance, the faster that curve starts climbing away from you. Here is where it gets even more uncomfortable. Most people believe they are safe because they pay the minimum payment every month. The minimum payment is one of the most cleverly designed financial traps ever created. It is calculated to keep you in debt for the maximum possible amount of time while always feeling like you are doing the responsible thing by paying something every month. A balance of $3,000 on a card with 20% interest, paid only at minimum payments, will take you over a decade to fully pay off. You will end up paying nearly double the original amount by the time it is cleared. That is not a worst-case scenario. That is the mathematically guaranteed outcome that the credit card company designed the minimum payment system to produce. The most disturbing truth about credit card interest is that it does not discriminate based on how financially responsible you feel. It hits the person who genuinely forgot to pay just as hard as it hits the person who never had a plan at all. One missed month, one unexpected expense, one moment where life gets complicated, and the interest machine switches on and starts running the numbers in the bank's favor immediately. The first hidden cost that most credit card users completely misunderstand is the annual fee, and before you say, "I have a no annual fee card so this does not apply to me," stay right there because that is exactly the trap they want you to fall into. The no annual fee card is not a gift. It is a business decision, and every business decision exists to make the company more money, not to save you more money. Credit card companies that charge annual fees are at least being somewhat honest with you. They are saying here is what this card costs you every year, take it or leave it. But the no annual fee cards are the ones playing a much more sophisticated game behind the scenes. They recover that fee money and then some through other channels that are far less visible and far more expensive for the average cardholder over time. Here is something that will make you think twice the next time you feel proud of your no annual fee card. Premium cards that charge $300, $500, even $600 per year in annual fees are specifically designed for people who understand value exchange. The bank gives you airport lounges, travel credits, and concierge services because they know the type of customer paying that fee is financially educated enough to extract real value from those perks. The no annual fee customer, on the other hand, is viewed very differently by the credit card company. They are seen as someone who is more likely to carry a balance occasionally, more likely to miss a payment, more likely to use the card at merchants that generate high swipe fees, and more likely to stay loyal to the card without ever negotiating better terms. You are not their charity case, you are actually their more profitable customer in many situations. So the real question you need to ask yourself is not whether your card has an annual fee. The real question is, what is this card actually costing me across every single way the company makes money from my behavior, and that number, when you add it all up honestly, is almost always far higher than any annual fee printed on the welcome letter that came with your card. The interest rate on your credit card is the most weaponized number in all of consumer finance, and the way it is presented to you is specifically designed to make it feel smaller and less dangerous than it actually is. When a bank tells you your card carries a 20% annual percentage rate, your brain processes that as a single yearly number, but that is not how credit card interest actually works against you in real life. Credit card interest is calculated daily, not monthly, and not yearly. That annual rate gets divided by 365, applied to your balance every single day, and then compounded on top of itself continuously. This means your debt does not grow in a straight line, it grows in a curve that accelerates over time, and the longer you carry even a small balance, the faster that curve starts climbing away from you. Here is where it gets even more uncomfortable. Most people believe they are safe because they pay the minimum payment every month. The minimum payment is one of the most cleverly designed financial traps ever created. It is calculated to keep you in debt for the maximum possible amount of time while always feeling like you are doing the responsible thing by paying something every month. A balance of $3,000 on a card with 20% interest, paid only at minimum payments, will take you over a decade to fully pay off. You will end up paying nearly double the original amount by the time it is cleared. That is not a worst-case scenario, that is the mathematically guaranteed outcome that the credit card company designed the minimum payment system to produce. The most disturbing truth about credit card interest is that it does not discriminate based on how financially responsible you feel. It hits the person who genuinely forgot to pay just as hard as it hits the person who never had a plan at all. One missed month, one unexpected expense, one moment where life gets complicated, and the interest machine switches on and starts running the numbers in the bank's favor immediately. Rewards points are the single most brilliant marketing invention the credit card industry has ever created, and the reason they are so brilliant is because they turn the act of spending money into something that feels like earning money. The moment you started getting points for purchases, your brain began associating swiping your card with winning, and that psychological shift changed your spending behavior in ways that benefit the bank far more than they will ever benefit you. Here is the first thing you need to understand about every single rewards program on the market. The money that funds your cashback, your airline miles, your hotel points, none of it comes from the credit card company's goodwill. It comes directly from the interchange fees charged to every merchant where you swipe your card, and those merchants recover that cost by quietly building it into the prices of everything they sell to every customer, including the ones paying cash. This means that people who do not use credit cards are effectively subsidizing the rewards of people who do. But even among credit card users, the reward system is deeply unequal. Studies have consistently shown that lower-income cardholders tend to carry balances and pay interest, while higher-income cardholders tend to pay in full and collect rewards. The interest paid by one group funds the rewards collected by the other group, and the bank profits from both sides of that equation simultaneously. The points valuation system is another layer of the trap that most people never examine closely enough. When your credit card company tells you that your points are worth 1 cent each, that valuation is set entirely by them and can be changed, devalued, or restricted at any time without meaningful notice to you. Airlines and hotel chains do this constantly. The flight that used to cost 40,000 miles now costs 70,000 miles, and your accumulated points just lost nearly half their purchasing power overnight. The cruelest part of the rewards trap is that it works most powerfully on the people it hurts the most. The more excited you are about earning points, the more you tend to spend to reach the next reward threshold. The more you spend, the higher your balance gets. The higher your balance gets, the more likely you are to carry some of it into the next month. And the moment you carry that balance. Foreign transaction fees are one of the most quietly expensive costs that credit card companies collect, and they are particularly dangerous because they only appear in situations where you are already distracted, excited, or overwhelmed. You are traveling, you are on vacation, you are finally living the life you worked hard for, and in those exact moments, your credit card is skimming an extra percentage off every single purchase you make without ever asking for your attention. The standard foreign transaction fee sits between 2 and 3% on most cards, and that number sounds harmless until you actually do the math on a real trip. Imagine spending $3,000 over a 2-week international vacation, which is genuinely modest when you factor in hotels, food, transport, and activities. At 3%, you have just silently handed your credit card company $90 for doing absolutely nothing except processing transactions they were already being paid interchange fees to process. What makes this fee particularly frustrating is that it is not tied to any real cost the bank is absorbing on your behalf. Currency conversion infrastructure has existed for decades and costs financial institutions fractions of a penny per transaction at modern scale. The foreign transaction fee is not a cost recovery mechanism. It is a pure profit extraction tool applied specifically in moments when customers are least likely to notice or complain about it appearing on their statement. The trap goes even deeper when you are abroad and faced with a choice at the payment terminal: pay in local currency or pay in your home currency through a process called dynamic currency conversion. Most travelers instinctively choose their home currency because it feels safer and more familiar. That single instinct costs you money every time because dynamic currency conversion applies its own separate exchange rate markup on top of whatever your card already charges, meaning you are essentially paying a hidden fee on top of a hidden fee simultaneously. The banks that offer no foreign transaction fee cards are not doing you a favor out of kindness. Late payment fees are designed to look like a punishment for irresponsible behavior, and that framing is intentional because it makes you feel like the fee is your fault rather than a revenue system that was engineered specifically to trigger as frequently as possible. Credit card companies do not hate late payments. They have built entire revenue forecasting models around predicting exactly how many of their customers will pay late each month and how much that will generate in fee income. The average late payment fee in the United States sits between $25 and $40 for a first offense, jumping even higher for repeat occurrences within a short window. But the fee itself is actually the smallest part of the damage a single late payment causes. The moment your payment crosses the due date, most credit card agreements contain penalty APR clauses that allow the bank to immediately raise your interest rate, sometimes to 29 or even 30%. And that penalty rate can legally remain on your account for a minimum of 6 consecutive months of on-time payments before they are required to review it. What most cardholders never realize is that the due date system itself is structured to maximize accidental lateness. Due dates do not fall on the same day of every month consistently in many cases. Payment processing times vary between banks, and the cutoff time for a payment to count as on time is often 5 p.m. rather than midnight, meaning a payment made online at 7 p.m. on your due date is already considered late by the time it is processed. The relationship between late payments and your credit score adds another dimension of damage that extends far beyond the fee itself. A single payment that is 30 days late can drop your credit score by 50 to 100 points depending on your overall credit profile. That score drop then follows you for 7 years, affecting your ability to get favorable rates on car loans, mortgages, insurance premiums, and even job applications in industries that run credit checks as part of their hiring process. The most sophisticated part of this entire system is that the people most likely to pay late are also the people least able to afford the consequences. The day your credit card company sends you a notification saying congratulations, your credit limit has been increased, feels like a reward. It feels like the bank has looked at your financial behavior, decided you are trustworthy, and given you a gift as recognition of your responsibility. That feeling is not accidental. It was carefully engineered by behavioral psychologists working directly with financial institutions to trigger exactly that emotional response at exactly the right moment. Credit limit increases are not rewards. They are calculated business decisions made when the bank's data models identify that you have reached a spending pattern stable enough to safely absorb more debt without immediately defaulting. The increase is not offered because you have earned more purchasing power, it is offered because the algorithm determined that you are now a good candidate for carrying a larger balance, which generates more interest income for the bank over the coming months and years. The psychological mechanism that makes limit increases so dangerous is something behavioral economists call lifestyle creep acceleration. When your limit jumps from $5,000 to $8,000, your brain automatically recalibrates what feels like a safe balance to carry. A $2,000 balance that previously felt like 40% utilization now feels like only 25%, and that mental shift quietly gives you permission to spend more without consciously deciding to do so. There is also a deeply uncomfortable truth about how credit limit increases interact with your credit score that most financial content never addresses honestly. While a higher limit can improve your utilization ratio and temporarily boost your score, the available credit itself becomes a liability in the eyes of mortgage lenders and certain loan underwriters. A person with $80,000 in available credit card limits is seen as someone who could theoretically take on $80,000 in new debt overnight, and that potential liability factors into lending decisions even when every card carries a zero balance. The correct response when your credit card company offers you a limit increase is not automatic acceptance, and it is certainly not celebration. It is a deliberate. The minimum payment box on your monthly credit card statement is one of the most consequential numbers in your entire financial life, and it is presented in the smallest, least emphasized section of your bill for a reason that has nothing to do with design aesthetics. Banks have spent enormous amounts of money researching exactly how to display payment information in ways that consistently lead customers toward the choice that generates the most long-term revenue for the institution rather than the most long-term benefit for the cardholder. Research conducted after the Truth in Lending Act required banks to show payoff projections on statements revealed something deeply troubling about human psychology. When people see a minimum payment number, their brain anchors to that number as the normal and acceptable amount to pay. Even people who could comfortably afford to pay significantly more than the minimum consistently pay amounts much closer to the minimum simply because that number was the most prominently displayed option available to them on the statement. The mathematics behind minimum payment structures are worth understanding in precise detail because the numbers are genuinely shocking when laid out honestly. Most minimum payments are calculated as either a flat fee or 1 to 2% of your outstanding balance, whichever is greater. This means that as your balance grows, your minimum payment grows just enough to feel manageable while never growing enough to actually make meaningful progress against the principal amount you originally borrowed. A cardholder with $6,000 in credit card debt paying only minimums at an 18% interest rate will spend approximately 9 years paying off that balance. Over those 9 years they will pay roughly $5,000 in interest alone, meaning the total cost of that $6,000 debt ballooned to nearly $11,000 by the time the final payment clears. That is not a hypothetical worst-case scenario manufactured to frighten you, that is the standard mathematical outcome of a system deliberately calibrated to produce exactly that result. The most important financial habit you can build around credit cards has nothing to do with which card you choose, which rewards program you join, or which bank you trust with your business. It is simply this. The balance transfer fee is the first thing buried beneath that attractive 0% promise. Almost every balance transfer offer on the market charges between 3 and 5% of the total amount being transferred as an upfront fee collected on day one before you have made a single payment. On a $5,000 transfer that fee is between $150 and $250, taken immediately, non-negotiable, and conveniently framed as a small price for the massive benefit of 0% interest that is coming your way. The promotional period expiration is where the real danger lives for the vast majority of people who use balance transfers. Banks have extremely detailed data on customer repayment behavior, and that data consistently shows that a significant percentage of cardholders who open balance transfer cards do not fully pay off their transferred balance before the promotional period ends. The bank knows this before they send you the offer. The 0% period is calibrated to be just short enough that a meaningful portion of customers will still be carrying a balance when it expires. When that promotional period ends, the interest rate that activates is not the standard rate you might expect from a normal card. Balance transfer cards frequently carry some of the highest standard APRs available in the consumer credit market, often between 25 and 29%, because the bank needs to compensate for the revenue they deferred during the 0% window. Every month you spent paying down that balance interest-free is a month the bank was patient about, knowing statistically that a percentage of customers would hand them a large remaining balance at a very high rate right on schedule. The balance transfer trap is most dangerous not because it is a bad tool in absolute terms but because it creates a psychological false finish line. The moment you transfer your balance you feel relief. The debt still exists in exactly the same amount but the emotional weight of it lifts because the interest pressure is temporarily gone. That relief is precisely what causes people to slow their repayment urgency, maintain spending on their old card which now has a fresh available limit, and arrive at the end of the promotional period with more total debt than they started with rather than less. Everything covered in this video points to one central truth that the credit card industry has invested billions of dollars in advertising, lobbying, and behavioral research to make sure you never clearly see. Credit cards are not financial tools that occasionally have costs attached to them, they are revenue extraction systems that occasionally provide genuine value to the small percentage of users sophisticated enough to navigate every single trap discussed in this video simultaneously without ever making a single mistake. The people who truly win with credit cards are a very specific and very small group. They pay their full balance every single month without a single exception across years of card usage. They never carry a balance transfer beyond the promotional window. They never accept a credit limit increase without deliberate evaluation. They calculate the real value of their rewards against every fee and behavior change the rewards program produces in them. And they treat every single communication from their credit card company with the same healthy skepticism they would apply to any business trying to sell them something designed primarily to benefit the seller. The uncomfortable reality for the vast majority of cardholders is that they do not belong to that winning group, not because they are financially irresponsible or unintelligent, but because the system was specifically designed by teams of economists, psychologists, and data scientists to make consistent perfect behavior extraordinarily difficult to maintain across years and decades of real life with all its unexpected expenses, emotional spending moments, and financial pressures. What you do with this information is now entirely your decision. You can choose to become the rare cardholder who uses the system without being used by it, and this video has given you the specific knowledge required to attempt that. Or you can make the equally valid decision that the cognitive load of navigating every trap perfectly is not worth the marginal rewards and simply reduce your dependence on credit cards in favor of financial tools that do not require constant vigilance to avoid being quietly drained by the very product you are trusting with your money. What you cannot do anymore, and this is the most important thing this video has given you, is claim that you did not know. The hidden costs are no longer hidden from you. The machinery is visible.